What's happening right now in the gold market isn't just another rally. It's the setup for something we haven't witnessed in over 4 decades. Let me show you what I mean. Central banks around the world just bought over 1,000 tons of gold for the third consecutive year. Think about that. These are the institutions that print money. They create currency out of thin air. And yet, they're converting that currency into physical gold at a pace we haven't seen since the 1970s. Why? Because they know something most investors don't. They're watching the same charts, reading the same economic data, and they're making a calculated bet that gold is about to enter a supercycle that could dwarf every previous bull market in modern history. But here's where it gets interesting. This isn't just about central banks. The entire structure of the gold market is shifting in ways that create the perfect storm for a historic price explosion. Let me walk you through what's really happening. First, understand the mechanics. Gold trades in two worlds. There's paper gold, the futures contracts, the ETFs, the derivatives that trade on exchanges. And then there's physical gold, the actual metal sitting in vaults, worn as jewelry, held by central banks. For years, these two markets moved in tandem. Paper gold prices reflected physical gold availability. But something broke in that relationship recently. And that break is creating pressure that has to release somewhere. The COMEX, that's the major exchange where gold futures trade in New York, is showing something remarkable. Open interest is climbing, while registered inventory is falling. In plain English, more people are making claims on gold that doesn't exist in deliverable form. It's like a game of musical chairs, except the music is still playing and people keep joining the game while chairs are being removed. Now, you might think, well, most futures contracts settle in cash, not physical delivery. And you'd be right. Historically, only about 1 to 3% of gold futures contracts result in actual metal changing hands. The rest get rolled forward or cash settled. But what happens when that percentage starts climbing? What happens when more contract holders start demanding physical delivery instead of accepting cash settlement? We're starting to find out. The London Bullion Market Association, the LBMA, recently published data showing that physical gold flows are tightening. The spread between bid and ask prices for large bars is widening. Delivery times are extending. These are all signs of stress in the physical market. And here's the kicker. While physical availability tightens, demand is exploding from multiple directions simultaneously. Let's start with those central banks I mentioned. Poland's central bank governor went on record stating they're targeting gold to represent 20% of their reserves. They're currently at about 13%. That means they need to buy roughly 100 more tons. Turkey's been buying aggressively. China's been buying month after month, though many analysts believe their official numbers understate their actual accumulation. India's central bank is buying. Singapore's buying. Even countries you wouldn't expect are loading up. The Philippines just announced plans to increase their gold reserves. Kazakhstan is buying. Uzbekistan is buying. This isn't random. This is coordinated de-dollarization in action. See? When you hold U.S. Treasury bonds as reserves, you're exposed to U.S. monetary policy, U.S. political decisions, U.S. sanctions. Gold doesn't have a counterparty. It can't be frozen. It can't be sanctioned. It can't be inflated away by another country's central bank. The BRICS nations, Brazil, Russia, India, China, South Africa, have been openly discussing a gold-backed trade settlement system. Whether that actually materializes or not is almost beside the point. The fact that they're discussing it publicly signals their intent to reduce dollar dependence. And every step toward de-dollarization is a step toward higher gold prices. But central banks are just one piece of this puzzle. Western investment demand is returning after years of absence. Gold ETFs saw outflows for nearly 2 years as investors chased tech stocks and crypto. But that trend reversed. Money is flowing back into gold ETFs at an accelerating pace. Why now? Because the macro environment is shifting in ways that make gold attractive again. Real interest rates, that's nominal rates minus inflation, are still relatively low by historical standards. When real rates are low, gold becomes more attractive because the opportunity cost of holding it decreases. But there's something deeper happening. Investors are starting to question the sustainability of current debt levels. The U.S. national debt just crossed $36 trillion. That's trillion with a T, Annual deficits are running over $2 trillion even during supposed economic expansion. At some point, the math stops working. Either you inflate the debt away, which destroys the currency's purchasing power, or you default, which destroys confidence in the currency. Either way, gold wins. Smart money is positioning for this now, before the crisis becomes obvious to everyone. And then there's the supply side of the equation, which might be the most bullish factor of all. Gold mine production has essentially plateaued. Despite higher prices incentivizing more exploration and development, new discoveries aren't replacing depleting reserves fast enough. The easy gold has been found. What remains requires deeper drilling, lower-grade ore, more expensive extraction. Major mining companies are reporting declining production. Barrick Gold, Newmont, AngloGold Ashanti, the biggest names in the industry, are all facing the same challenge. Their existing mines are aging, and new projects take 7 to 10 years from discovery to production. You can't just turn on a switch and produce more gold when prices rise. The supply response is measured in decades, not months. Meanwhile, industrial demand for gold is growing. Electronics manufacturers need it for semiconductors and circuit boards. The green energy transition requires gold for solar panels and electric vehicle components. Medical devices use gold for its biocompatibility and conductivity. This industrial demand is relatively price inelastic. A smartphone manufacturer isn't going to stop using gold in their circuit boards because the price went up 20%. They'll pay the higher price and pass it on to consumers, so you have supply that can't increase quickly, industrial demand that's growing and price insensitive, investment demand that's surging, and central bank buying that shows no signs of slowing. What do you think happens to price? But let me show you why this could be truly historic. Not just another bull market. Go back to 1971. Nixon closed the gold window, ending dollar convertibility to gold. Gold was fixed at $35 an ounce. Within 9 years, it hit $850. That's a 24x increase. What drove that? Inflation, currency debasement, geopolitical instability, and a loss of confidence in fiat currency. Sound familiar? The difference is, in 1971, gold was coming off decades of price suppression. It was artificially held down by government policy. When that dam broke, the price exploded. Today we have a different kind of suppression. Not official government policy, but the sheer weight of paper gold contracts creating artificial supply. Futures markets allow for leverage and speculation that can temporarily overwhelm physical demand signals, but that only works as long as people accept cash settlement. The moment physical delivery becomes the norm rather than the exception, the paper market loses its price-setting power, and we're seeing early signs of that shift. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description, covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to where this price is headed. The technical picture is equally compelling. Gold recently broke out of a multi-year consolidation pattern. In technical analysis terms, it cleared resistance that had held for years. When you get a breakout after a long consolidation, the subsequent move tends to be powerful and sustained. The 50-day moving average crossed above the 200-day moving average, what technicians call a golden cross. Historically, this signal has preceded significant rallies. Momentum indicators are showing strength without being overbought. That suggests room to run higher before hitting technical resistance. But here's what really matters. The fundamental drivers behind this move aren't temporary. This isn't a trade. This is a structural shift in how the global monetary system operates. For 50 years, the world ran on a dollar-centric system. The US dollar was the reserve currency, the medium for international trade, the anchor for global finance. That system is fracturing, not collapsing overnight, not disappearing tomorrow, but fracturing slowly, then suddenly, as these things tend to happen. Every country that increases its gold reserves is voting with their actions. They're saying, we need an alternative to dollar dependence. Every ounce of gold that moves from west to east represents a shift in economic power and monetary philosophy. China and India, representing nearly 3 billion people, have cultural affinities for gold that Western nations lost generations ago. As their middle classes grow, their gold demand grows, not as speculation, but as savings, as wealth preservation, as cultural tradition. This demand is structural and permanent. It doesn't fluctuate with market sentiment or interest rates. It's embedded in how these societies think about money and value. Now layer on top of that the Western institutional demand that's just beginning to return. Pension funds, endowments, sovereign wealth funds, these massive pools of capital are starting to allocate to gold again after years of underweighting it. Even a small shift in allocation from these institutions represents enormous buying power. If pension funds globally moved just 2% of their assets into gold, that would represent demand far exceeding annual mine production. The market simply couldn't absorb that flow without significant price appreciation. And here's the thing about gold that makes it different from almost any other asset. There's no terminal value calculation. You can't build a discounted cash flow model for gold because it doesn't produce cash flows. Its value is entirely based on what someone else will pay for it, which is determined by supply, demand, and monetary conditions. In a world of expanding money supply, growing debt, and declining confidence in fiat currency, gold's value proposition strengthens. Think about what's happened to money supply over the past few years. The Federal Reserve's balance sheet exploded. The European Central Bank printed trillions. The Bank of Japan has been printing for decades. China's money supply has grown exponentially. All that new currency has to go somewhere. Some went into stocks, creating the everything bubble. Some went into real estate, pricing out entire generations from home ownership. Some went into bonds, pushing yields to historic lows. But increasingly, it's flowing into hard assets. Things that can't be printed. Things with inherent scarcity. Gold is the ultimate hard asset. It's been money for 5,000 years. It's survived every empire, every currency, every financial system that's ever existed. When people lose faith in paper, they return to gold. It's happened throughout history, and it's happening again now. The question isn't whether gold will go higher. The question is how high and how fast. Some analysts are calling for $3,000 in the near term. Others see $5,000 as the next major target. The more aggressive forecasts suggest $10,000 or higher in a true monetary crisis scenario. Are those numbers realistic? Let's do some math. In 1980, gold peaked at $850. Adjusted for official inflation, that's roughly $3,200 in today's dollars. But official inflation numbers significantly understate real inflation in housing, healthcare, education, and other major expenses. Using alternative inflation measures, that 1980 peak would be closer to $5,000, $6,000 today. And remember, in 1980, the U.S. debt-to-GDP ratio was around 30%. Today, it's over 120%. The monetary base was a fraction of what it is now. The global financial system was far less leveraged. In other words, the conditions that drove gold to $850 in 1980 are far more extreme today. So why shouldn't the price response be more extreme? But here's what really keeps me up at night. What happens if we get a real crisis? Not a garden variety recession, but a genuine loss of confidence in the monetary system. In that scenario, gold doesn't just go up, it gaps up. It becomes unavailable at any price because no one wants to sell. The bid-ask spread blows out. Premiums on physical metal over paper prices explode. We saw a taste of this during the 2020 pandemic panic. Physical gold premiums spiked to $100 over spot price. Dealers ran out of inventory. Mints couldn't produce coins fast enough. That was a temporary disruption. Imagine a sustained crisis where that becomes the norm rather than the exception. The paper gold market would collapse. Futures contracts would settle in cash because physical delivery would be impossible. The price discovery mechanism would shift entirely to the physical market. And in the physical market, price is determined by whoever is willing to sell. If no one wants to sell, price goes vertical. I'm not predicting that scenario. I'm saying it's a possibility that's more likely today than at any point in the past 50 years. The smart money isn't waiting to find out. They're positioning now, while gold is still available, while premiums are reasonable, while while the crowd is still skeptical. Because here's the thing about historic moves. By the time they're obvious to everyone, they're mostly over. The big gains happen while people are still debating whether it's real. In 1971, gold was $35. People said it was overvalued. In 1975, it was $200. People said it had gone too far. In 1979, it was $500. People said it was a bubble. Then it went to $850 in a matter of months. The people who made life-changing returns weren't the ones who bought at $800. They were the ones who bought at $35, $50, $100, and held through the skepticism and volatility. We're in that early phase now. Gold has broken out. Yes. It's making new highs. Yes. But relative to where it could go, given the fundamental drivers, we're still in the early innings. The central bank buying isn't stopping. The supply constraints aren't resolving. The monetary expansion isn't reversing. The geopolitical tensions aren't easing. The debt levels aren't declining. Every single factor that drives gold higher is not only present, but intensifying. And here's the final piece that ties it all together: market psychology. Right now, most investors are still skeptical of gold. They've been trained for years to believe that stocks always go up, that the Fed has everything under control, that inflation is transitory, that debt doesn't matter. That consensus is starting to crack. Not breaking yet, but cracking. You can see it in the flows into gold ETFs. You can see it in the premiums on physical metal. You can see it in the central bank buying. When that consensus fully breaks, when the crowd realizes that maybe the emperor has no clothes, that maybe infinite debt and money printing do have consequences, that maybe gold isn't a barbarous relic after all, that's when the real move happens. That's when gold doesn't just go up 20% or 50%. That's when it doubles, triples, goes up fivefold or more. Because at that point, it's not about making money. It's about preserving wealth. It's about having something real in a world of financial abstraction. And when that shift happens, there isn't enough gold to go around. Not at current prices. Not even close. The total value of all gold ever mined is roughly $15 trillion. That sounds like a lot until you compare it to global financial assets of over $400 trillion. Gold represents less than 4% of global financial wealth. If that percentage moved to just 5% or 6%, the price would have to double or triple to accommodate the demand. If it moved to 10%, which is still below historical norms, gold would need to increase fivefold or more. These aren't wild speculations. These are mathematical necessities based on supply and demand. The gold is finite. The demand is growing. The monetary expansion is continuing. The geopolitical fragmentation is accelerating. This isn't a matter of if. It's a matter of when and how much. The setup is historic because all the factors that drive major gold bull markets are present simultaneously and reinforcing each other. Monetary debasement, check. Geopolitical instability, check. Supply constraints, check. Central bank buying, check. Declining confidence in fiat currency, check. Technical breakout, check. Shifting market psychology, check. Every box is ticked. Every indicator is flashing. Every signal is pointing in the same direction. The last time we had this kind of alignment was the 1970s, and we know how that ended. The difference is, today's imbalances are far larger. The debt is far higher. The monetary expansion is far more extreme. The geopolitical tensions are far more complex, which suggests the resolution will be far more dramatic. Gold isn't just setting up for a good year or a nice rally. It's setting up for a generational move that will redefine how people think about money, value, and wealth preservation. The question you need to ask yourself is simple. When you look back 5 years from now, will you wish you had paid attention to what was happening right now? Will you wish you had positioned yourself before it became obvious to everyone? Because that's how historic opportunities work. They're only obvious in hindsight. In the moment, there's always a reason to wait, to be skeptical, to think it's too late or too risky. But the people who build lasting wealth are the ones who recognize structural shifts before the crowd does. They're the ones who act on evidence and logic rather than emotion and consensus. The evidence is clear. The logic is sound. The setup is historic. What you do with that information is up to you. Urgent. Gold is setting up for a historic run. Record-breaking.